Good morning. This is Efrem Hoffman, broadcasting from NakedSwanTrading.com on May the 10th, 2012 at 7:23 a.m. The risk map that you see on the screen right now is for Walt Disney Corporation. Each bar on the screen, or candlestick on the screen, starts back, prior to the drop that occurred in the actually from the period of April 2011 down to the low that took place in October 7th, 2011, and then recently we had that nice big rally leading into earnings that just took place in Walt Disney, and basically price spiked as high as $45.80 on on the week of May the 11th, okay, which is where we are right now, okay, and a lot of people are looking at the fact that the movie The Avengers being positive for Disney so far to the tune of over 200 million is pretty bullish indicator, considering that last week the market closed at 42.93 and we got as high as 45.80, and now we're sitting at around 45.02 in the current session, with an ask of 45.07 and a bid of 44.42 at the low end of the order book pre-market. Now, unfortunately for the bulls in this stock, that run-up that took place off of October was a little far and a little too fast, but in the big picture and the big scheme of things, this stock is significantly overvalued from an investment point of view, for the next several years. And what the risk map is indicating right now is that there are two areas of risk windows present in the market. One extends, we're in the active phase right now, but technically that phase continues basically out into January the 18th, 2013 to as far as May 31st, 2013. The trigger level, from today's date, because we're in the window, as of this week, okay, would basically be getting on the other side of the teal boundary or getting on the other side of the red boundary. And let me explain what I mean by that. Right now, here's where the current price is. And you can see right now it's trailing the teal boundary. When the teal boundary is sloped up, getting a weekly bar underneath that boundary would confirm a sell signal. Even though right now we're entering the risk box, we could discuss how far price is constrained, but to actually say, hey, there's going to be an acceleration on the downside, that's going to blow prices out of the water. Basically, you're contained right now on a weekly basis to around 41.72, okay, going into June the 22nd. So even if there's a sell signal short term, which there are a number setting up, and really in the short term all you really need to do is get on the other side of 44.11, okay, and that going into that, say, June the 29th. It doesn't even have to be then. You could just, I would say, just getting underneath 44.81 in going into the end of the week of May 25th. If you get a full week underneath there, then yeah, you could. There'll be support offered at 41.72. Okay, but the problem is that when this red boundary gets on the other side of this white boundary, and we'll provide updates when that happens, then at that point, getting on the other side of this red boundary opens up a down move down to $40.48 to this red line at around $38.90. Okay, and basically, while this red line is sloped down, that could offer some support, but that's just a short-term. That's just the short-term piece to this move. The real dangerous part is that what happens if this market just kind of stays above this teal boundary, all the way in. Let's imagine it stayed all the way above 43.61. So it'll be capped on the upside, because the upside, basically, once you get on the other side of this red boundary, you're going to be capped on the upside by 47.09, 47.89, 48.03, and 49.33 is going to cap this market all the way out into 2016. So considering where the stock is right now and the amount of time somebody would have to wait for an extended move to the upside, there's an awful lot of risk to the downside. And, getting on the other side of this teal boundary, and you got some severe downside risk, at least in the near term, to that 41.76, and then if you get below that area, then as I indicated, the 38. But if we just hug above this teal boundary, and now let's imagine it's December 28th, 2012, okay, and now price gets underneath $43.57 to 43.61, okay, and you could see that's where it starts out. Then it rises over here. So if you get up to, let's say, April, and you get underneath $45, if price hasn't got on the other side of that, then basically your risk is, initially there'll be a move down to 38.67. You get a weekly trade underneath 38.48, and you're talking about a move, okay, that puts risk initially down to the $28.55 area. Now, if there was an all-out sellout and it happened prior to that period, then there's some support at $30.50 to 28.87. Okay, longer term, here's where the real danger is. This black line that's kind of curling underneath this red line while they're both sloped up, when price gets on the other side of this teal boundary, the teal boundary will forever, during that interval, constrain prices to the upside and start dragging them down. And any boundaries that are sloped up means that individual groups of traders from different time horizons are going to be changing their sentiment to more bearish indicators. And when prices get below those boundary conditions in the future, then it means that they'll be accelerating their negative perceptions of price movement. Okay? And it'll be harder for news flow to influence those changes. Okay? And so basically, when we get past the February 21st, 2014 area, because up until then, in general, prices are constrained to 27.17 in the worst case scenario. Okay? Potentially, if there was a spike, maybe down to 25.55. But the point to take home is, from a trading point of view, you want to be selling on the other side of this teal line. Okay? You want to be treating these areas as resistance. Okay? Near-term resistance, the nearest term being 47.08 as overhead resistance. And then basically, if, in 2014, if we get underneath any of the areas where you see like the solid red on the screen, okay, then, or at any point up here initially where you see solid red, then it'll take you down to this area where you see solid blue. Over here, you get below this solid red, it'll take you down to the solid blue. And then, so there's some long-term support at 2093 to 1818 going out into 2014 to 2016, okay? In the event that, the market gaps underneath here after taking some profit, then basically the next critical area is 1480. All bets are off after December 30th, 2016 if you take out 1480. But that's really, really far out into the future. I believe the real value in the map is to try to identify areas of overvaluation while a market is either moving to an extreme on one side or the other. In this case, it's moving to an extreme on the upside, and not just on a daily basis, but on a multi-week basis, a very long-term basis. And this is the dangerous area. This black line is the threshold. So, at any point, getting a full week trading underneath, 3677 to an area of 3717, okay, anywhere starting from July 20th through the period of December 4th, 2015. At any time that happens, you're talking about a severe acceleration to the downside. In terms of just having a large-scale correction from this upper resistance, or where the current price is right now, down to the 38.48 area is a very real possibility over the next 12 months. And now if I drill down to a shorter term time horizon, you're going to see the activity here. So this is a picture of Walt Disney on the daily chart. And what you're going to see here, this is a zoomed in picture. So basically starting May 21st, okay, so we've got an area starting around May 21st into the July 12th area. We're taking out 43.73, meaning price trading underneath there for one day. That opens up a down move to 40.77, okay? And that offers support it's not a buy area. It's just an area where there could be an intraday bounce for a second. But as soon as you get a day that gets underneath 40.70, and everything is prime to do that, starting May the 21st going into July 25th. If you get a day that trades underneath there, then there's huge downside risk to that 38 area that we showed you on the weekly charts. But from the bigger picture point of view, you're bounded. Basically, we'd be bounded at 47.03 to 49.33 if in the event of a spike, but 46.50 to 46.29 to 46.50 is about all it could really do. The key area for this market, if I zoom in over here on the really, really short term for the next dangerous area, is a situation where price gets on the right-hand side of this blue boundary. And you can see here, if there was no change in price, and this is where price is as of yesterday, there was no change in price and you just drew a horizontal line across, we would get on the other side of the blue boundary after May the 21st. By then the blue boundary would be capped at around 46.13, and then you would basically have a heavy sell signal based on the daily charts confirmed, and then taking out this critical level at 43.73 would just accelerate the move. But whether you take out that price or not, once you get on the other side of this blue boundary, the blue boundary is going to act as resistance, and you're going to be capped along here. So at the very best, from a trading point of view, you're in an extremely high-risk area because the market is going to be building a consolidation, and then it's going to break out of this area. And when it breaks out of that area, you know, whether it breaks out here, but you could see here we got this zonal flow area of this black line that basically has critical support at 44.01 to 44.24. You take out that area for more than 1 week, okay, after August 6th, okay, if we don't already take out that 43.73 area by the time June 12th arrives, then you're going down to any boundary that is sloped down. And you could see there's 35.92 would be like the outside spike to 37.11. So that is consistent with some of the range support on the weekly chart. And then of course, you know, as you get into later this year, you know, there's another area of risk that if you kind of get underneath this area while this band starts sloping up, that's around like October 25th into January 15th. If you get underneath the area of 35.62, then you're in danger to 29.19. Okay. Now breaking underneath 29.19, you know, for more than a day, you know, that could yield severe problems and ultimately long-term take you down to 25 bucks. Some of the numbers you're seeing here on the daily chart obviously are slightly different than the weekly chart. You don't need confirmation on both time horizons to indicate a trade. Basically, whatever's indicated on each map individually represents an action that is valid. And just to remind you that everything indicated on this market call so far is for informational purposes only. So this is not an investment recommendation. So we advise you to, you know, do this at your discretion and discuss this with the financial advisor. But at any event, the bottom line is that Disney is overvalued. There's extreme overhead resistance from 44.44, 44.70 if we get on the other side of that boundary on May 21st, but 47.03 to 49.39 with the mid area of 46.50 is long-term overhead resistance where the market's going to have a hell of a time, and all it's going to likely do is really have some serious trouble as we go into, you know, when it flips on the other side of this red line as early as this month or before June 12th. And that area of support continues through next year, critical support. That doesn't mean an area to be buying. It means an area to look to sell when it gets underneath there. And there's some serious downside potential. So what will be happening here on NakedSwanTrading.com is we will provide updates in real time, intraday, so that as we get into those zones, and there are some short-term trades to take, they will be made available to subscribers. Select ones will be made available on our website as we see fit. But we look forward to sharing more of these observations in additional Dow stocks and among the other 10,000 assets that we actually follow worldwide. So we thank you for attending today and look forward to providing updates in the future. Thank you.